Buying a first stock can feel bigger than the dollar amount. Before the first purchase, the market is just moving numbers. After the purchase, every green candle can feel like validation, and every red candle can feel personal. The goal of a first stock is not to become rich overnight. A better goal is learning how ownership, risk, price, and behavior work. This walkthrough uses fictional names, hypothetical numbers, and a generic brokerage screen, so the focus stays on education, not recommendations.
A stock is a small ownership claim on a company. The chart moves every second, but the business changes more slowly. Behind the price are customers, products, revenue, costs, profits, cash, debt, and management decisions. Beginners often start by watching the line and then inventing a story to explain it. A stronger process starts with the business first and the price second. The question becomes, what does this company do? How does it make money? What could hurt it? And what expectations are already built into the market price?
Before buying anything, define the job of the money. Is it long-term learning capital, or is it money needed soon for rent, debt, emergency savings, tuition, or a major purchase? Stocks can fall sharply, even when the long-term story seems reasonable. Money needed soon usually does not have time to recover from a sudden drawdown. A first stock works better as a controlled lesson when the basic safety base is already considered. Forced selling is one of the easiest ways for a decent investment idea to become a bad personal outcome. The next step is choosing a regulated brokerage available in the viewer's country. This is not about chasing the flashiest app. The research checklist includes registration, account protections, fees, available markets, fractional shares if needed, order types, support, and clear statements. Be careful with social media links, private group chats, unknown apps, or anyone promising high returns with little risk. Legitimate investing does not require secret access from a stranger online. If a platform or person pressures for immediate action, that pressure itself is useful information. Different countries offer different account types. Some are taxable brokerage accounts, some are retirement accounts. Some have tax advantages, contribution limits, withdrawal rules, or penalties. This video cannot decide which account fits a specific person. The educational point is that the account wrapper matters. The same security can create different tax and reporting consequences depending on where it is held. The buying click is easy. The account decision deserves slower thinking. And when taxes or legal rules become personal, a qualified professional is the right source. For a first stock, a useful filter is simple. Can the business be explained in 1 minute without using hype? What does it sell? Who buys it? Why might customers keep paying? Who are the competitors? What could break the story? If the only answer is that the chart has been rising, the thesis is weak. Price momentum can be real, but it is not the same as business understanding. A clear thesis does not guarantee profit. It simply makes the decision testable instead of emotional. The first layer of analysis does not require a professional model. Start with revenue, profit, free cash flow, debt, and valuation. Revenue shows whether the business is growing. Profit and cash flow show whether growth is becoming economic value. Debt shows financial pressure. Valuation asks whether the price already expects too much. None of these metrics works alone. A fast-growing company can still be expensive. A cheap-looking company can be cheap for a reason. The purpose is not perfect prediction. It is avoiding blind buying. A common beginner mistake is loving the company and ignoring the price. A great business can still be a disappointing investment if the purchase price assumes flawless execution. Imagine a beautiful house listed far above any reasonable value. The house can be wonderful while the deal is unattractive. Stocks work the same way. Investment return comes from a combination of business performance and price paid. This is why analysis needs both sides, quality and valuation. A story without price discipline can turn enthusiasm into overpayment. Position size should be decided before buying, not after emotion enters the room. For a first stock, small can be powerful because it allows learning without letting one mistake dominate the portfolio. Thinking in percentages helps. A $100 position means something different inside a $1,000 portfolio than inside a $50,000 portfolio. Concentration is not automatically wrong, but it must be intentional. The question is not only how much can this make, it is also how much damage can this create if the thesis is wrong. Before placing a trade, understand basic order types. A market order is designed to execute quickly, but the final execution price is not guaranteed. A limit order sets a maximum price for a buy order or a minimum price for a sell order, although execution is not guaranteed. In highly liquid stocks, the difference may be small. In volatile or thinly traded securities, it can matter more. Order types and rules can vary by brokerage, so the educational habit is to slow down and read the order preview carefully. The actual buying process is mechanical. Search the ticker carefully, confirm the company name, confirm the exchange, choose shares or dollar amount if fractional shares are available, choose the order type, review estimated cost, review fees, and only then submit if the decision still matches the plan. Many first-time errors are simple input errors, not deep investment mistakes. A ticker can look similar to another ticker. A share quantity can be typed incorrectly. A calm review screen is part of risk management. A watch list creates distance between interest and action. Instead of buying immediately after hearing a company name, place the fictional ticker on a list and write what needs to be learned. What does the business sell? What are the key risks? When is the next earnings update? What valuation range would make the idea more or less attractive? A watch list turns urgency into observation. This is useful because many poor first purchases happen inside a rush. Waiting does not guarantee a better outcome, but it can reduce decisions made from excitement alone. Before buying, check the cost structure. Some platforms advertise zero commissions, but there may still be spreads, currency conversion costs, account fees, transfer fees, inactivity fees, or tax reporting complexity. Fees that look small can matter over time, especially when they repeat. A beginner does not need to become obsessed with every decimal, but the habit is important. Read the fee schedule, understand how the platform gets paid, and avoid unnecessary activity. The goal is to make the first trade a controlled lesson, not an expensive habit. Some brokerages offer fractional shares, which means an investor may buy a dollar amount instead of a full share. This can help beginners control position size, especially when one full share is expensive. But fractional access does not remove risk. A small piece of a risky company is still a risky asset. Cash control matters too. Leaving some cash uninvested is not automatically failure. It can be part of pacing the learning process. The important idea is to size the first purchase around a plan, not around the share price. Before placing money anywhere, run a basic scam filter. Is someone promising guaranteed returns? Is there pressure to act quickly? Is the opportunity only available through a private chat? Is a stranger asking for deposits through an unfamiliar link? Is the pitch focused on screenshots of profits instead of clear risks? These are red flags. Real investing still has risk, documents, disclosures, and uncertainty. A boring verification step can protect a beginner from the most damaging mistake, sending money to something that is not a legitimate investment platform. A risk plan explains what happens if the thesis is wrong. It can include position size, maximum portfolio exposure, review triggers, and the facts that would change the decision. The risk plan is not a promise that losses will be avoided. It is a way to prevent surprise from becoming panic. If a stock falls because the whole market is down, the response may be different from a fall caused by the business thesis breaking. Thinking about these branches before buying makes the investor less reactive later. After the purchase, create a review schedule. Daily price movement can be noisy. Business updates usually arrive more slowly through earnings reports, management commentary, product news, debt changes, competitive shifts, and regulatory developments. A review schedule asks whether the thesis is intact, not whether the price moved since breakfast. This habit helps separate signal from noise. A beginner who checks the chart every few minutes may feel active, but activity is not the same as analysis. The review system is where learning compounds. Common first-time traps include buying because a video sounded confident, confusing a familiar brand with a good investment, putting too much money into one idea, ignoring fees, and treating a lucky gain as proof of skill. Another trap is changing the reason after the price moves. If the original thesis was growth, do not quietly replace it with dividends because the growth story weakened. Write the reason first, then hold the decision accountable to that reason. This is how the first stock becomes a teacher instead of a mood swing. The first stock is only one data point. Over time, the investor can decide whether individual stocks, broad funds, or a mix fits their temperament. One person may discover they love business research. Another may discover that a diversified fund process is calmer and easier to maintain. Both discoveries are useful. The goal is not to look sophisticated online. The goal is to build a repeatable system that can survive boredom, greed, fear, and uncertainty. A portfolio is a behavior system, not just a list of holdings. Right before submitting the order, pause for a simple audit. Is the ticker correct? Is the company name correct? Is the order type understood? Is the position size small enough for learning? Is the reason written down? Is the money truly available for risk? Is this decision coming from a process or from fear of missing out? A slow final check may feel unnecessary, but it is one of the cheapest forms of risk control. The habit matters more than the first trade itself. After the purchase, write down the thesis in plain language. Why was it bought? What risks matter? What would prove the idea wrong? When will it be reviewed? This turns the purchase from a dopamine event into a learning loop. Then avoid refreshing the price every 5 minutes and calling that research. A stock can rise after a weak decision and fall after a reasonable decision. Judge the process over time. The first stock should not define the investor's identity. It should make the next decision more thoughtful. The real win from a first stock is not a perfect entry price. It is a better investor on the other side of the decision. If the stock rises, the lesson is not automatically genius. If the stock falls, the lesson is not automatically failure. The useful question is whether the process was clear, sized responsibly, documented, and reviewed honestly. That is how one small purchase becomes education. The first stock is not the finish line. It is the beginning of a repeatable decision system.